Good afternoon, and thank you for joining us for this episode of Keeping It Simple. Today, we are delighted to have John Toohig from Raymond James, and of course, Harley Bassman and Mike Green. Today's conversation is absolutely going to be entertaining. Hopefully, it will be informative. Should not be taken as investment advice. Would love for everyone to contribute. So there's a Q&A button down at the bottom of the screen. Please contribute your questions there, and then we'll incorporate them in the conversation. So thanks again for joining us today. Mike, take us away.
All right, fantastic. I listen, this is a really exciting one. I'd love to have John here. John is a regular correspondent of mine on the credit side. He works at Raymond James. And John, you're involved in the Brian, I think we're still trapped on you on the screen, but uh, John works in what's called the whole loan business, which is very much like the difference between white bread and whole wheat bread. It's just more nutritious. Is that right, John?
It's exactly right. If the pre-call is anything that kind of goes along with, stay with that particular theme, and we'll be having a lot of good times on this discussion, right? I know whole loan business, raw loans, just raw credits, nothing in bond form, nothing in CUSIP form. We're dealing with what banks and credit unions and loan officers and loan originators are making every day.
Okay, and so this is actually a very different, model because the model that largely dominates, the one that we see when we talk about the bond market or when we talk about the structured product market, that is typically taking thousands, if not millions, of loans and compiling them together to create statistical oddities that don't actually care about the underlying individual credits. They care about how they behave in aggregate. By focusing on the whole loan space, like basically what you are doing is focusing on the traditional metrics of can this individual borrower pay back? And in many ways, that actually creates a richness, which we have to acknowledge has a component of anecdata to it as compared to the broad statistical pictures we may have. But the really critical story that I think a lot of people often forget from The Big Short is that it's when those individual securities are underwritten, the quality of those loans that are going into these broader macroeconomic indices and aggregates that we see as the quote unquote tradable portion of a lot of this stuff, it really is tied to the same underlying phenomenon. So you're kind of getting a front row seat as credits, hopefully not your own, start to degrade in quality.
Right now, completely right. So we're dealing with the actual originator themselves, not necessarily the one that's into the bond, and analyzing their portfolios. And so we often do feel as if we have a little bit of a front row seat, as whether it be their mortgage portfolio or their automobile portfolio or their commercial real estate, which has obviously been a hot topic of late, student lending, unsecured lending, credit card lending, and we're looking at that quarterly with them. So as we go through, it's almost like analyzing your own stock portfolio, right? But we're doing that for their loan portfolio and looking at where there are trends, are originations rising or originations falling, is credit strengthening or weakening, and then following those remittance reports and looking at the deals and trades that we've done and tracking them over time. Are prepayments rising, are delinquencies rising, are charge-offs rising? What are the severity of those charge-offs? Are we making more recoveries on auto loans because used car prices are better or worse? Or are we having any losses in the mortgage and the residential market because home values are so robust? All of those things kind of come to light in our discussions with customers through, the calling effort of our sales force and getting a look kind of into the portfolio and understanding the risk.
Now, one of the things that always jumps out at me about the credit space is that it really is, in many ways, individual, and then there are common factors. And on tariff day, or actually the day after tariff day,
right? Yeah,
right, which is ironically, by the way, yesterday was National Ferret Day, and I felt very like the ferrets were shunned until I realized that ferret pronounced backwards is tariff. So we actually, maybe that was the impetus. Who knows?
I think you're the only one who drew that conclusion,
I
but
think
could
that
be
would not be the least bit surprising. By the way,
right.
also in terms of drawing alternate conclusions, encourage everyone to grab a beer. I'm reaching out to the country of Japan to extend an olive leaf with an Asahi, or a Sapporo, actually, sorry, a Sapporo today. So I encourage everyone to join after today's events. Um, Harley, we had a couple of questions that we wanted to put up in poll form first. You want to launch into those, and then we'll jump to the next part. John, unfortunately, you don't get to answer, but you get to comment afterwards.
Lovely.
Go ahead, baby.
All right. Will Trump privatize the GSEs? Yes or no? And is the affordability index still relevant? This is referring to the household affordability index. How much does it cost to buy a house? Can you afford a house, et cetera? let's see what the audience comes back and thinks, and then let's evaluate it and talk about some of those individual components. Those very much play through. Will Trump privatize the GSEs? All right, 69%. I think that's where I would certainly fall out. And is the affordability index still relevant? Split completely down the middle. John, what's your thought?
I would love to see him do so just to get them back into the business. We are Fannie and Freddie approved here and have been for some 30 years. And it's just, they're not the same entity they used to be. Great. And I think it's an enormously important part of the mortgage market. I think it's vital to the mortgage market, candidly. But it is, something needs to change.
Run that back again. They're not involved in the market right now. And if we privatize them, they would be.
So presently in my world, what we call the bulk trade market, I can't take $100 million of residential seasoned loans and deliver them into Fannie or Freddie anymore. They closed what they call the bulk window back in March of 2020 when COVID hit. And they have not yet reopened it. So that would be a lovely thing to see liquidity come back into banks for their legacy mortgages if we could deliver back into the GSEs.
Okay.
They'll do one loan at a time. They'll do what they call flow, and institutions are still delivering individual loans in, but the bulk window is closed.
I would say that privatizing is nuclear Armageddon and would strictly be Trump doing payback to Ackman for his support. Privatization is an unmitigated disaster, only second to what we had before when they were basically a government-sponsored hedge fund that took down the whole damn market. So what do I know?
Yeah, Harley, I was hoping you would actually share your real opinion with us.
I mean, this is for realsies, man. I mean, we go in back to the stockholders get the upside and the government gets the downside. This is exactly how we got our last two disasters in 04, 06, and the other time over here with 2020. You know,
Harley, not to pick on it, but I might argue
hazard.
that some of the private label bonds that were loans and mortgages that were, no income, no asset, no problem, no pulse, those were the ones that underperformed. Fannie and Freddie certainly had their problems. I'm not saying that they were heroes in the process, but it was more the private label stuff that really underperformed.
So I actually agree with John on this one. I think the evidence was pretty clear. The argument against it on the flip side, of course, is that Fannie and Freddie were crowding out the higher quality stuff and subsidizing a lot of the junk, which in turn led people to conclude the characteristics around lower quality loans was significantly better than it actually was. I think a big chunk.
You think China and Japan or anyone else in the world is going to buy a Fannie or Freddie bond if it's not basically full faith and credit of the U.S. government?
I do not, which is exactly why I think that your overall observation is correct, that what we have become accustomed to is mortgages without a credit component to them to the end customer. The question becomes, do we remove the ability to underwrite that in the process of privatizing would be one issue, right? Because these are now companies that theoretically, under a truly privatized framework, would have to really consider that. That's not entirely bad, right? But there are social goods associated with subsidizing mortgage credit that we shouldn't ignore either.
A lot.
Well, you want to talk about affordability. I mean, we're one of the only countries in the world that has a 30-year fixed rate mortgage, and
Us in
comes
Denmark,
off
yes.
And that, by the way, I do want to make sure that people focus on that because that's a really, really important observation. That more than anything else has been why the housing market in the United States has held up. If people had faced a rapid adjustment of their mortgages, correct, on the consumer side, then this would have been an entirely different problem. That actually opens up a line of discussion that I think is probably worth starting with, which is one of the hypotheses that I've raised, John, and I've put this forward, and I think I have it in the presentation materials, is this idea of is the rate policy contractionary or is it stimulative? And so let me actually pull up that slide. Assuming I can find it. There we go.
John, I want to put a pin in the affordability thing once Mike gets done, okay?
Yeah, well, I want to come back to it, actually. I think
let's do it.
Which is this issue of, will the Fed cut, which now feels increasingly inevitable, right? We've had the obligatory sell-off in the stock market. The concerns have been raised. The natural reaction is the Fed's going to pull forward cuts, particularly if today's Challenger report in terms of layoffs is borne out by tomorrow's employment report in any way, shape, or form. The expectation suddenly becomes that the Fed is going to try to become stimulative by cutting rates. I'm a little mixed on this. I'm not entirely sure what the impact of this is, because if they cut by 50 basis points, that has a much bigger effect on the income flowing through to the private sector through things like money market funds than it does to the cost of servicing debt in today's regime. John, your view from the whole loan space?
Well, so it's a great question. And if we can rewind to last year, we thought we were going to get 6 cuts, and obviously that didn't come true. At what point does 2 cuts become stimulus, and at what point are we trying to resuscitate an economy, right? Are we taking a little heat off the stove? If we're having more than 2 or 3 cuts, I think we're more worried about recessionary things. Now, when we start talking about recession, I start pointing to credit. And when I start pointing to credit, somebody's ability to repay their debt, a consumer's ability to repay their debt. So in that particular rate, a falling rate environment probably also means that the borrower's FICO is worsening, which means it becoming more difficult for them to access credit. A quarter point here, a quarter point there, and the world's not falling apart, I think is a good thing for lenders and consumers. An immediate 75 basis point shock cut, or six cuts over the course of 25, probably to me says we've got some credit problems brewing.
And that then, of course, immediately morphs us into the latest news that we've gotten on the impact of student loans in particular. This is, of course, carrying through to things like FHA and others. John, you brought some of this to my attention, and you and I have had discussions around this. We just got a piece that's very much, Max, I actually drew on your chart. I apologize for my scribbling, and as Harley would put it, the chartreuse credit line. But one of the things that happened in this cycle was that, again, you go back to March 2020 or to 2020, we basically said, okay, everybody's credit is good, right? We don't care who you are. We don't care whether you have a job. We basically took the ninja concept and extended it to everyone. And then we formally decided to declare, I think it was in 2022, is that right? That basically everybody's credit report was purged and everybody was current on any government loan or any type of financing that had been extended to them. One of the unforeseen impacts of this was to cause credit scores to rise. And so one of the things that people bullish on the economy and the credit formation have pointed to, they've said, look, there's not a lot of low quality credit borrowing happening. This is actually largely higher quality credit that's occurring. But it turns out that those were just low quality creditors in high quality sheep's clothing. Effectively, we're seeing the behavior that suggests that a 550 borrower relabeled as a 650 borrower behaves like a 550 borrower. A 620 borrower relabeled as a 700 borrower behaves like a 620 borrower, particularly once they begin to exhaust the new access to credit that they've experienced. John, your thoughts here?
Yeah, I mean, you're talking about FICO inflation, right?
Yep.
It's something we've seen. I mean, if I could bring one of my underwriters on the phone and we could talk about a 2008, realizing we're going way back, 720 FICO score, that's wildly different than a 720 FICO score today. We've monkeyed with the algorithm for a while now. We've removed certain pieces of the algorithm that help and inflate. And then to your point on this particular slide, even outright forgiveness, right? So you look at the onset now again of student loans, and those loans now counting against credit, and the impact that the student loans are going to have if somebody's FICO score is inflated because of this, and they miss that student loan payment, and you're a 720 FICO, your credit could drop as much as 160 points. So you go from a creditworthy, a near prime to prime creditworthy borrower to almost unlendable, or a hard money lender.
Yeah,
so
you gave me the example of the difference. Somebody moving from basically a 720, dropping that 160 points to a 590, their mortgage rate is going to do something like go from 7% up to 12, 13, 14, 15.
If you can find it.
If you can
John, are you saying that the FICO inflation of the last 4 years during Biden was a government supported idea as a way to go and improve the housing market and make credit more available, or was it done by
not just the housing market, all forms of credit, Harley?
Or was it done by Fair Isaac to go improve it? Like, was the government sticking their finger, because like CPI, the government manufactured 20 years ago to make it go down for various reasons. I'm curious if you think this was a good deed gone awry, or it was government policy.
Before you
we
answer that, John, I just have to point out that Harley always manages to interject a fictional composition into his observation. So let's focus on the credit component here, then we can talk about the inflation.
Sure. So if we can rewind to COVID, and it was a weird time, and we saw a lot of forbearance, and we saw a lot of forgiveness, and we saw a lot of servicers go into this and say, listen, we're going to freeze for a minute. If we all remember July of 2020, when we were drinking all the hard bourbon that we could find and eating all the good stuff, and we didn't care about working out, we were just trying to figure out if we were going to survive. A lot of people didn't know if they had jobs still, if they could make their payments, auto loan, car loan. And so you saw a number of institutions say, all right, we're on pause. And even there was stimulus given, right? And dollars put out there, and everybody was still trying to figure this out. Now, where consumers, we kind of ranked into three buckets. One, they were a bad actor. They knew they were taking advantage of the system. They didn't make a payment and they could. There was another character out there who was just scared, and he froze, and he took advantage of the stimulus, and he didn't make his payment, but he probably could have. And then there was those that continued to make their payments throughout. It's that first guy that you were wondering about, the bad actors out there that took the benefit of a system, and manipulated it. And those are the ones that saw their FICO scores likely improve. Now we're turning credit back on, and we're not seeing those programs anymore. It's becoming evident in the FICO score who was what.
You're saying it's more of an unintended consequence than an actual policy idea.
Well, it's human bad behavior, but I mean, we could also argue about, was the policy done correctly? That's maybe a different conversation, but certainly there are going to be those bad actors out there that take advantage of it.
Yeah, and I do think this is the chart that I have up on the screen is student loans, and unfortunately I misspelled Bueller, which ruins the joke. The simple reality is that we're still saying that student loan characteristics as of December 2024, that these are basically money good, that nobody is defaulting on them, nobody is in delinquency, etc. What the New York Fed came out with earlier this week was a paper that basically said, yeah, that's all a lie. And I don't know how else to frame it than to highlight that and to emphasize that the entire point of a capitalist system is to use price as a mechanism of information exchange. If you suppress price, if you suppress information in a capitalist system, you're going to get malinvestment. You're going to get money allocated in ways that it shouldn't have been. And the simple reality is this is very similar to the phenomenon that occurred around Silicon Valley Bank, in which Harley and I have argued this forever. I actually now have the CIO of Silicon Valley Bank who's going to be coming onto our program to tell Harley to go pound sand. But the simple reality is,
you mean the guy that blew up the bank is going to come on and tell me something?
Actually, this is interesting. Not the guy who blew up the bank, but the guy who tried to stop the bank from blowing up. And exactly as I described, was suppressed by the leadership that said we can't take the hit to earnings.
Okay, fair enough.
All right. But with that said, we're now suddenly in a situation where, just like Silicon Valley Bank listened to the Fed and who had said, we are not hiking rates for a very long time, and therefore did not hedge a lot of their rate exposure and duration, that blew up. Student loan borrowers were told, we're going to get rid of this debt. They believed us, right? And so, joke's on them. And I say that in the most cynical possible way. I can really understand how frustrated and angry these borrowers are going to be when they suddenly discover that they have no reasonable prospect of getting into a house now, regardless of what happens to housing prices.
Well, this is the same reason why I don't believe in the dots or forward guidance, because it just creates moral hazard.
That's exactly correct, Harley. You and I are in agreement on at least one thing.
I think we had a conversation with a lender today. It was interesting. We were going through their portfolio, and they were actually cheering the fact that we're out now, right? These student loan borrowers, whether they're good or bad actors, could or couldn't make their payments. The meter is turned back on. Now we get back to the transparency of understanding the credit, and the economic morphine and the mask of underperformance or overperformance is behind us, and we get to see what the impact is when they don't make their payment. Now, it's going to be negative for some of those folks that will have a harder time accessing that credit and getting a cheaper cost of funds and debt service. But we're seeing it, we're through it, and we're no longer hiding behind it and ignoring what could be a time bomb or not.
Yeah, I unfortunately see it in a similar fashion. I'm glad that the period of obfuscation is now behind us. I'm a little terrified to open the box.
Let me
Understand?
connect the dots between affordability and Mike's chart about
Yeah, perfect.
whether rates go up or down have an impact. John, there's been a large number of cash closings, all cash deals. And I would propose that the all cash deals are happening because this is the way we transition the boomers' money down to their kids via the back door and escaping escaping taxes. Therefore, rates really don't matter because mom and pa are going to go give that money along. Are you seeing something like that, an increase in all cash deals with rates going up like this?
I mean, it's mostly purchase money these days. You certainly don't see a whole lot of refi
Oh,
business. I
yeah.
think that's true. I
Yeah,
mean,
purchase money, sure.
as you look at that purchase money, I don't get necessarily as granular to say, it's gifts. There's always been a component of gifts and whatnot, but yeah, I mean, you're seeing a struggle for individuals who have to take financing. Because that all cash deal, remember, Harley, I wouldn't see because they just bought it outright. They wouldn't necessarily have a mortgage associated with it. The
That's
loans
true.
that I see are the loans that actually have debt associated with it. But folks are having a harder time making that down payment. Property values, even in the face of 7% mortgages, have continued to go up because we don't have enough supply. It's a building issue. Builders got destroyed in 2008, 2010. They never really came back. And blessedly here today on
Yeah,
tariff.
just very
Go ahead.
very quickly to
Yep.
interject
Yeah.
a little bit of the fact pattern there. The independent builder got destroyed. The national home builder with a captive finance unit that's capable of discounting those loans, et cetera, has ironically kept many of those from coming back in because they're unfortunately competing against, if you are an independent builder, even in this period of relative shortage, you couldn't offer a much more attractive rate to your potential buyer, and therefore you were undercut by the national home builders as well. So the flexibility of supply has been really weak in terms of responding to this.
Yeah, we're definitely not though seeing what we saw back in 2006, where we would throw up gutters and pipes and betting on the come that the borrower was going to show up out in the middle of nowhere at suburb. We certainly don't have any of that. I mean, bets on entire developments, 60, 70 homes getting thrown up at one time. Yeah, that's we're just not seeing that anymore.
The
Yeah,
other the other thing I would just add to that very quickly, Harley, is this is one of those things that if you go back to that time period, and I would actually challenge John a little bit, it wasn't so much 2006, it was 2005
5,
when
3,
that was
4.
really
Yeah, that's right.
happening.
You're right. You're right.
And a big chunk of why that actually ended was not tied to rates. It was tied to the spike in gasoline prices. Suddenly, a home that was an hour and a half away from your job became an unaffordable luxury because gasoline prices rose so much. You were driving a Jeep Grand Cherokee with a V8 engine getting 11 miles to the gallon. When gasoline prices went from $2 to nearly $5, that basically wiped out the economic value of that home and turned it into a situation in which people walked away from many of these
Jingle mail
properties, right? The
Yep.
jingle mail component,
Yep.
while holding on to their automobile because that was their mechanism to get a job or maintain their job. That in turn created a narrative that people would always pay their auto loans. How's that holding up this cycle, John?
So again, New York Fed, credit to them on putting that out. They did that study just here recently, and the joke from 2008 was, you can sleep in your car, but you can't drive your house to work. There was a lot of conversation around, okay, did Zoom or did Uber change that, 15 years into the future? The results of their study were interesting to me is that they still feel that the priority of wallet, the priority of payment is still going towards the home and not as much towards the car, not because of Zoom, but because of the inherent equity in the property still. They actually have money in it this time. If we remember 2005, we were doing 125% loan to value financing. That's all gone. I mean, if you can do 80% financing, 90% financing, you're kind of lucky. Down payment still required. So it's still prior to payment on the home, but it's particularly prior to payment on the home that has equity in it.
Yep. And that then hits the low end of the market where we are seeing a lot of these negative amortization loans, effectively modifications by FHA in particular.
Your
Once
Jenny product,
again,
right?
that once again were not disclosed, right? So we have been flying blind in terms of the quantity of loans that have been already entered into modifications and delayed payments, where a lot of the balance is effectively put onto the back end, just replicating 125% loan to value. It's just because home prices have appreciated and not reversed that we're still showing that as significant positive real estate equity. John, you actually hit on exactly this topic. I want to share a couple of slides that you had sent me. One is this idea of household wealth by percentile group. One of the things that people keep saying, and I think this is accurate, we actually have a chart on this as well, that the majority of spending is actually tied to the very wealthiest, right? About 50% of spend is coming out of 10% of the population. If I look at that in terms of net worth, though, I think a lot of people have been very comforted by the increase in net worth that's occurred at the bottom end of the spectrum. You had an interesting chart, though, that actually broke down where that wealth is coming from. And the key point that I would highlight for people is it's actually shocking if you look at the net worth of that bottom 50%, what a large fraction of it is actually tied to housing. And this is one of the things that, again, I think we need to be very careful in digging into data and understanding how difficult it is, to evaluate that claim without understanding how much older that cohort has also gotten, right? Most of this household equity are basically old people who are now much lower income or even wealth levels, but have full equity in their homes. They've paid off their mortgage, et cetera.
Well, if anybody's tried to buy a home lately, right? Can you buy the same amount of square footage as opposed to what you bought 10 years ago? Probably not.
Yep.
It's going to be a lot more expensive if you have to finance it. I mean, today you're probably talking about 6.5% as opposed to that 3% forever mortgage. So now we get back to that debt service coverage conversation of a $1,200 a month mortgage payment instead of a $2,400 a month. And that hits the wallet, right? So you got a lot of trapped equity, which is lovely in that you have money in it. But if you did try to tap into that, where do you go if you try to sell that property?
Mm-hmm.
You don't really have a great solution if you do decide to jump.
How do you explain house prices going up the last 3 years? I wrote a commentary 3 years ago, basically predicting house prices would drop by about 20%. The idea being that nobody buys a house, they sign up for a payment plan. And most people don't get fancy Wall Street bonuses. They have a W-2 income that is what it is, and they can allocate a third to housing, which means that, when rates go up, they can afford a smaller loan. It's affordability whole thing is a disconnect to me, that with rates having gone up by this much, prices should have gone down and not up. What do you attribute that to?
It's a complex answer, Harley. It's a great question. Want to go back to supply. Not enough supply is the simple answer as to why housing is held. Maybe during COVID as well, a very strong focus on shelter. We all had to hunker down, and we did do this work from home thing for a while. 3 is rates. Rates are oppressively high, and affordability is an issue. But there aren't other alternatives. And so if somebody could sell and downsize and move into something else, can they find the next unit to jump into? Is kind of 3 on that. We're starting to see some home equity products pop up. We're starting to see HELOCs come back. We're starting to see personal loans come back to kind of pull some of that equity out, which can kind of help take some of the sting out of that, but it's still early days in those.
I'm wondering if the lack of supply is from fewer houses being built, or people are trapped in their homes because the rate's at 3%, they can't afford to move.
It's a little bit of both, I think.
Yeah, I think that's exactly right. And I would just emphasize that, we saw a little bit of this today, but remember, Harley, that depressed prices, particularly in housing, is almost always a byproduct of forced selling. What is truly different this time around in 2006, 2007, 2008, because we'd never contemplated having a national mortgage crisis, we had no real mechanism for mitigation procedures on how to dispose of homes that people return through jingle mail. And so many banks at least started off with the process of just dump the things. REO auctions were a regular feature of that time. That just doesn't exist today. That's actually one of the scary things.
A little too clean. Yeah.
I mean, that's one of the things that's scary about the FHA component, is what we're discovering is that the mitigation procedures now largely involve we will do almost anything to make sure you don't have to get out of your house.
Yep, very true.
Right.
John, I'm a career mortgage guy. I will confess I was never familiar with the Fannie Freddie blacklists of bad HOAs and everything else. I suspect you are familiar. Is this improving your business because people can't put loans into the GSEs?
I mean, so any loan that's been sold into a bond, obviously I can't trade, right? So if it's in a CUSIP, it's a missed
No, but I'm saying
opportunity for me.
there's like 5,000 HOAs that can't get a Fannie Mae loan anymore. So
Yeah, I mean,
it
is
goes to the
going
whole
into
market.
the private market, the non-conforming market that's the world that I live in. So certainly seeing plenty of asset depletion loans, bank statement loans, associate all kinds of different, something that doesn't qualify for Fannie and Freddie, and there's a vibrant market for that. Where there's an article today in Bloomberg talking about how private credit's taking over mortgage. It's true. There's not just a standard anymore that is Fannie and Freddie. That's a byproduct of the financial crisis. You have J.P. Morgan kind of wanting to take over that market. Redwood Trust is obviously a super prime jumbo lender that's enormously well respected. And then as you kind of dive deeper into that underbelly of lending and you get into those non-QM type lenders, Harley, you can see anything under the sun. You can see foreign nationals, I-10 loans, asset depletion, bank statements. We haven't gotten to the point where we're doing no income, no asset NINA or CISA kind of loans, but I mean, I am starting to hear lenders come out there and say, we will do 110% loan to value again. We just did that at SF Vegas a month or so back. And so it's interesting to watch as some of the things that we lived through in 05 to 10 are starting to kind of come back around.
And the one thing I would add to that, Harley, also is because home prices have stayed relatively firm, and John alluded to this, and it's part of what you're identifying as well. The home, even at a higher cost HELOC, what I'm seeing that's concerning, quote unquote, is we're beginning to see more and more tapping of HELOC without refinancing the initial loan. That tells me that people are reallocating their capital from their home to pay off their credit card bills or to pay off their car and effectively buying them time. If that works, that's great, right? If this is a transitory period of
Using a
economic
transitory
weakness.
word. Good Lord.
Well, I'm using it properly.
God.
But
Suppose I used to use it.
It's unmentionable. You can't, when Powell used that just the other day, I thought they were going to get the shepherd's hook and just yank him off this. He can't say that word again. Good.
Yeah, well, I happen to like the word. I think it speaks well of those of us who actually expected the inflation rate to retreat. I understand it's been tarred by those who think that means the price level, but that's a different argument. But this is actually a sign that we are seeing that stress start to extend, and it is good. I just want to emphasize this. It's good that people have the access to home equity lines of credit to pay down their 29% credit card debt that comes from having improperly forecast either their income or their expenses, right? There's nothing necessarily bad about that occurring, but it is ultimately raising the risk that we're going to see these things come right back into distressed selling if the economy weakens from that point. We've got a number of people who are hitting us here and asking questions around some of these things. In particular, I've got a question on why haven't we seen the return of adjustable rate mortgages? John, you want to offer something on that? And then Harley?
So no, that's a great question. And I would tell you we are, and again, early innings, but a positively sloped yield curve is the answer to your question. The fact that 2s and 10s are positively sloped. And usually we see about a 50 basis point differential between a 30-year fixed rate mortgage and a 5.6. I got to train myself to say 5.6. I always say 5.1 or 7.1 back from the SOFR and LIBOR days. So with that cheaper coupon, will drive, I think, more ARM originations. Now, two things. One, Fannie and Freddie's price to ARMs has always sucked. Like it's never been good. Right. I mean, that's kind of the joke of the market. So that's very much a bank and a very much a credit union product. It's a balance sheet project. It's not as much of a bond driven product. So as banks in particular start to push that particular product back out, and they get confidence that those are loans that are kind of in the money still, we're going to see more ARMs. And we already have, from a trading standpoint, we're seeing more ARM transactions these days than we have certainly in the last 3 years. So ARMs, we think, are coming back and have been coming back.
And along that line, you highlight that this is a balance sheet product. That is one of the key questions ultimately is, will the balance sheets be robust enough to hold these things? Harley, your interest rate volatility that you have highlighted so successfully is also one of these contributors, because in the process of, if you are going to manufacture a bond out of an adjustable rate mortgage, you do have to convert that into a fixed rate product. That in turn is very expensive in a period of elevated interest rate volatility relative to what we've seen in the past. So it does become really a balance sheet product as compared to something that can be securitized as it was pre-GFC.
No, but look, I think the demise of First Republic was a crime against humanity for the ultra
Strongly
rich.
agree.
I mean,
Yep.
they
I'm sorry, I have to pause for a second. A crime against humanity for the ultra rich. Okay.
right.
Harley's looking out for that 0.1%.
One of the best run banks in the country,
really
a
was.
good and long customer of ours, a true trade. It's a shame that
It
bank's
is a
not
true
still in
tragedy.
existence.
I actually agree with the characterization, although I think it's hysterical.
And not having warm chocolate chip cookies in the branch anymore is a real loss to humanity.
I mean, they lent money to guys who didn't need money. I mean,
Zuckerberg got a loan there.
I really don't know how they went under. It took us extraordinary effort. Maybe
It's
the
called
CIO
interest rate risk, and it's
the
real.
CIO,
Yes.
I guess he was First Republic, went to SVP. So
Yeah.
Now, what we know happened is the same thing, unfortunately, that happened to SVB, which is what they were doing is they were subsidizing a relationship with warm cookies and discounted mortgages, and therefore you had a ton of money sitting in their deposits, earning.
no, that wasn't First Republic. First Republic just booked the loans.
No. First Republic was very much. I banked with First Republic.
First Republic would give you a 1/4 point discount if you were an ACH customer. They give you a 1/4 point discount if you had a certain amount of deposits on hand. They give you another 1/4 point discount if you had clean pay for 6 months. And so the next thing you know, you had a coupon that was 75 basis points underwater for nothing other than a relationship. And the moment they were asked to sell that loan, and it was 87 cents on the dollar, oh God, I'm upside down.
But they had no defaults.
They're absolutely pristine. This was nothing but getting caught at the absolute wrong moment on a liquidity crunch.
Yeah, I agree. It's one of the greatest tragedies. As they were in the process of going out,
Wonderful institution.
I was trying to get my banker to sell me my individual mortgage, knowing that they had it on their balance sheet. I was not able to successfully negotiate that. Would have been nice. Okay, let's hit one other quick question, because now we're jumping suddenly. We've identified that there are credit risks that are emerging out there. We're suddenly talking about the dynamics of what happens as these begin to flow through, and we're forced to recognize this. We're talking about a material degradation in a sizable fraction of the U.S. borrowing market. The question was asked about credit spreads, and I'm going to share my, this is not my model of credit spreads. It's just a quick picture of credit spreads with an interesting wrinkle added to it. We want to go here. So here we're looking at in red, these are credit spreads for high yield. This is the high yield CDS spread. And in the blue line, this is the 12-month moving average for actual realized corporate bankruptcies. Above $50 million in assets. And one of the things that's been surprising to me is how little recognition or accommodation there has been for the rising defaults and delinquencies that are occurring in the corporate sector. And it doesn't really seem to be registering in the high yield space. My argument is it's largely tied to a lack of issuance, even as money flows into the space. John, what's your thought?
I'm not a corporate credit guy. I'm a consumer credit guy. So when I look at that individual borrower, I mean, loan growth has been really challenged. I mean, at 7% mortgages, at 10% auto loans. I mean, at 15% personal unsecured loans, at 22% credit cards. That's what's limiting, spreads and growth. The consumer can't afford it. Those rates, they no longer qualify for those particular situations.
And I would argue that extends into the corporate space. We're seeing that maturity wall grow. We're seeing very short-term extensions that are being offered. People are converting from 8-year loans at origination to 2-year loan extensions, effectively trying to buy themselves time for rates.
That's the commercial real estate market in particular right now.
Yeah.
That is very firmly the market that is seeing, is even the sponsor, the borrower is saying, I don't want 10-year paper. Please don't give me a 10-year loan. Give me a 3+1+1 loan. Give me a 5-year term. I'm betting that rates will come down, and I'm praying that rates will come down, because right now I can't afford the current rate.
And John brings up a fantastic point. We are at our core a religious nation, so we will pray for lower rates. But this is one of the challenges. It's one of the things that I identified last year, is that the residual pressure on inflation, and in particular, what I would argue is actual residual seasonality in inflation. It's why we've seen inflation prints in the fourth and first quarter be much higher than they were in the second and third quarter of last year. A lot of that is residual seasonality, but it caused the Fed to blink. And they went from 6 cuts that people were hoping and praying for to instead those prayers have not been realized. And instead, we're suddenly facing a situation where those loans are a year further in, and suddenly those companies are faced with refinancing at still currently high rates. This is the area where I would agree with John that if the Fed decides that this is it and they want to cut fast, it's going to provide a lot of relief to the corporate credit sector and probably commercial real estate and others, if nothing else, just buying more time.
I'm not worried about the resi market. This isn't 2008, The Big Short. I don't
Yep.
think it's the replay. I'm worried about the commercial market.
That's
the one
as am I. I am much
that I
more.
think has the bigger risk at the moment, in that we have seen extend and pretend. In 2023, we knew we had some problem commercial loans. Office was the easy one to pick on, but there are other assets that aren't doing well either. 2024, we were ready for those 6 cuts. Guess what? They never came. And here we are now in 25, and higher for longer is hanging around. Today might change the world with the tariff tantrum that we're having right now. But lower rates is again the prayer of most anybody in commercial real estate, so they can refinance their way out of this. But what we're hearing from lenders is that they can't squeeze any more blood out of the stone. When they go to that sponsor and they ask them to put more equity in the property, there's nothing more to give. So in that regard, if there is a shock, tariffs, a war, or otherwise, all of that extend and pretend, which you can see as non-accrual on the balance sheet, which you can see as modification on the balance sheet, that's when you feel the music stop, and then somebody doesn't have a chair to sit down in. That's the part that worries me. Extend and pretend is working fine right now until it doesn't.
Yeah, and I used this analogy in a discussion earlier today. Harley, I'd be interested in your reaction to it. You know, what we've effectively done with the tariff announcements today, and this goes to some of the questions that we're getting, in particular, the form that we took. I can't for the life of me defend the form. I can understand. It's actually, a lot of people have criticized them for being irrational, and it's been identified that there was a simple formula that was effectively used. Ironically, that formula is the correct formula if you wanted to figure out the level of tariffs that are required to balance trade in the goods sector, which is the area that it was focused. But what we did was we ignored the services surplus that we run. And so if you think about an extreme version, people have pointed out things like Madagascar, for example. Well, Madagascar runs a trade surplus with the United States in goods, but a phenomenal deficit in services. Right? They effectively sell us vanilla. We buy from them the occasional jungle tour or beach holiday. And in exchange, they do a lot of Google searches and rely on the United States for a lot of data services and financial processing and various other components. By forcing a rebalancing strictly in the goods sector, by making that the component, it's very hard for me to see services as not getting hit effectively in the purchasing basket. Harley, what's your reaction to that?
This whole thing is misconstrued. I mean, the idea that the trade deficit is a bad thing is foolishness. The trade deficit is what supports the need for the US dollar as reserve currency and allows us to go and borrow money like drunken sailors. Why would the hell we want to go and flatten out the trade deficit? The dollar all of a sudden loses its value, and there we go. So that's where I stand on it. It's just misconstrued.
Yeah, it does feel, and I emphasize this fact, right, that equation is correct if you treat it as a single period action, right? It's basically the equivalent
With no consequences.
With no consequences, right?
Yes.
And so this is a continuous negotiated game where we have to go to the next cycle in every step in the process. There's a lot of commentary that's come through, like the American worker is going to suffer, et cetera. I got to be honest with you, I'm terrified for what's going to happen to Madagascar. I'm terrified what's going to happen to the rest of the world, where the U.S. has been that consumer of last resort. Yes, we will see higher prices, particularly in CPI, which is a basket, and I've emphasized this repeatedly. The CPI basket is fixed for a period of years, so it doesn't care that we decide to reduce our consumption of cars in calculating inflation. Cars going up by 25% to reflect tariffs, it means that CPI is going to go up in that category by whatever the producers don't eat. In things like PCE, though, or over a multiple time period, this is just a loss of income around the world. I don't see how we can see that as any other possible outcome. John, what's your reaction to this as a trained macroeconomist in the?
Yeah, thank you for that. I'm a lone trader. I can't say that I'm as well versed in all things economics, but again, I look at it to the consumer. If it's going to impact services, it's going to impact goods. If it's going to impact manufacturing, I'm just looking at the unemployment rates. If the unemployment rates ultimately rise, it's a bad thing for credit. All of those things, going even back to housing for a hot second, I usually get criticized for saying, hey, housing is going to rise. Well, housing is going to rise is great when we have 3% unemployment. Housing and home prices might not rise so much if we have 5% unemployment. So as all of these tariffs and all of these things impact, various other sectors, it's you're taking a look at what that ultimately does to the unemployment rate and how that unemployment rate ultimately impacts, the borrower's ability to repay.
John,
Go ahead, Harley. I'm sorry.
I was going to change the topic, Mike. You finish up over here.
No, I think that's actually fine. I was going to direct it another way as well. Let's hear where you want to go.
Well, seeing as we're an investment show, I guess we should talk about that. So a number of years ago, I invented what's called the convexity vortex. The idea was to go and kind of tap the idea of where the mortgage market would become maximum negatively convex. And of course, a mortgage bond is or a whole loan for that matter. It's a buy right, basically, a covered call strategy. I've proposed that the convexity in the mortgage market has diminished dramatically from where it was 15 years ago for a variety of reasons. With rates coming down over here, people are asking, is the mortgage market a little more dangerous now? Is it more negatively convex? What do you think about that?
It's a tale of two products. Yesterday's loan at 3% coupons. Obviously, if you're buying that loan at 85 cents on the dollar, we love the convexity in that particular concept. If we have increased prepayments and you get to have the loan paid off at par, fantastic. The opposite may be true today. A 7% coupon, 6.5% coupon, and you pay 102 for it, and all of a sudden prepayment speeds happen. Your yields get crushed because of increased speeds. So, whether you buy the loan or the bond, you're dealing really the fat middle. It doesn't exist. We went from 3% to 7% almost overnight. And there's not a lot of 5 and 6% coupons out there. You just have a whole lot of 3% and 4% coupons floating around out there.
Are you seeing the machinery of the mortgage market capable of refinancing people if rates move or not?
Absolutely. I mean, the world's a lot different than 2005. We have the auto dialers and United Wholesale and Rocket, right? I mean, they'll call you on a quarter. So I would expect to see very aggressive refis as that kind of goes down. Now, Harley, you mentioned it before, and back to the conversation on, rate cuts and is that stimulus. If credit is falling and we're getting lower rates as a result of a worse economy, does that borrower qualify anymore for the refinance? That's a different conversation in falling rates.
That is exactly where I wanted to take this, because that is really the key here, which is, the question has obviously been asked, what are the implications for investment? If the Fed does not cut fast, really, really fast, and unemployment starts to rise, then everything that John was just highlighting is the core issue. The question becomes, is a shrinking proportion of the population capable of refinancing into that? And that's particularly true because those who are most exposed to these higher rates are the younger generation who probably have student loan, who don't have the savings, who have bought a house that they paid way too much for and is now suddenly forced under somewhat distressed conditions to go back to office because they're worried about losing their job. And so this is going to be a very, very interesting one. I liken it to, we are crossing a canyon on a tightrope. Yes, on average, we're going to make it across, but if we try to walk 3 abreast, it's not going to happen.
Well, Mike, this is where your whole passive story runs into a head-on collision with the housing market, because as you stated, which I agree with, the passive market has driven us up in price because it's a flow market. People are buying stocks for their 401ks. As long as they have a job, they're going to keep doing it, and price doesn't matter. They're just going to keep moving the money in. If you lose your job, well, then you stop putting money into your 401k and you stop buying stocks. which similarly, if you lose your job, you can't make your mortgage payment. So you kind of get this double whammy of unemployment driving the stock market and the housing market down. Is that kind of where you are, Mikey?
Unfortunately, that is where I come out, and it is exactly what I'm starting to raise awareness of and trying to emphasize to people. One of the other factors that plays through that is ultimately this question that we've talked about in a couple of different places, Harley, which is this idea of, do the Europeans suddenly start bringing their money home? Do the Asians suddenly start bringing their money home? We have rightfully in the United States demanded that they invest more in their defense. The flip side of that is, where's that money going to come from? And the story
it doesn't
for the
come to us
past
anymore, right?
Yeah, exactly. And so the last 9 years, I mean, I've emphasized this in some of my writings. If you look at a place like the UK, crazily enough, only 15 cents of every retirement dollar, if you're a Vanguard retirement investor in the UK, only about 15 cents of a retirement dollar is being reinvested into the UK. 55 cents is being sent to the United States. And so it's not unreasonable at all for a country like the UK or France or others to turn around and say, hey, wait a second, we want that money to stay home if we're being asked to invest. This is where I suddenly start to embrace the arguments of people who are arguing for financial repression of a variety of forms.
Well, I'll push back on the notion of rightfully we should ask the Europeans to pay more for defense. If the trade-off is we're going to spend a few $100 billion more to go and nuclear umbrella France and Poland, but they agree to have the U.S. be the world's reserve currency. They agree to use U.S. laws. They agree to use the U.S. keeping the seas safe. I'll take that trade. I think people really underestimate the cost of the U.S. dollar not being the world's reserve currency.
I unfortunately agree with you. So that's now we're in an uncomfortable silence where we seem to have reached consensus.
Can we toss out the whole idea of the tariffs being a negotiating tactic? I mean, Trump can't control the 10-year. 10-year's fallen 60 basis points in 2 months. He seems to be doing a fine job of controlling the 10-year, whether it be in a ham-fisted way that might ruin the rest of the economy, but it is getting rates down. I'm just tossing that one out there for you.
No, there is a legitimate argument that you could make that is one of the single most important steps that is being taken. Certainly, Scott Bessent has indicated that's one of the primary objectives. And there is a bit of a grace period that the Trump administration has in which they can, in hindsight, say, well, that was the unwind of the Biden economy. Look how much better we've made it. But the clock is starting to tick on that. I mean, people, I put out a tweet earlier today saying it's fascinating. Donald Trump seems intent on having the 2 largest layoff periods and unemployment cycles in U.S. history in his 2 administrations. To be fair, COVID was not his fault per se, but he did sit by and allow the U.S. economy to be shut down.
And let's remember, he's a commercial guy, right?
Correct.
I mean, he understands commercial real estate, and he understands what lenders need, or sponsors, borrowers need right now: lower rates.
Correct.
I'm not saying that's the reason for all of this, but it's an interesting byproduct of the conversation.
If the Fed doesn't cut rates, the back end of the curve's done. I mean, there's only so much negative yield you could take if you're by owning long duration securities when the curve's inverted.
I'm not entirely sure I agree with you, Harley, because I do think that if the Fed doesn't cut rates, you're going to see credit spreads blow out, and that race for safety and bet that the Fed is then going to have to cut even more aggressively feels very much on. But I agree with you. This is actually the point. So part of my argument would be, based on what's going on now, I think the Federal Reserve never should have paused its cuts. I think they were misled by the residual seasonality and inflation. But with that said, they did. And so now they're behind the 8 ball in the opposite direction.
Wait, didn't Goldman tweet today that tariffs are going to be a 4.5% CPI print next quarter?
Harley, this is part of the reason why you do not have your tariffs set by short-term price pressures. You discuss long-term components of it. As we discussed, I think that there's a very reasonable chance that CPI comes in high simply because of the mechanism. I'd be much more surprised if we see the same thing coming out of PCE.
Look, we don't know if these tariffs are real or not. They might be, but I mean, look, the story is
he could cancel them
seriously, but not literally. And Trump, as a longtime New Yorker, I will tell you that Trump will scream bloody murder on A1 and then quietly settle on page B6 a few months later. So, I mean, it is very challenging for a company to go and start building a factory in the US based upon a couple of tweets over here.
I 100% with you. The uncertainty associated with this is the real killer.
That's it.
If we had confidence that these tariffs were going to be in place for a very long time, the reality is there would be a lot of foreign investment that would come into the United States in the same way it did into places like China in an attempt to access those markets.
Yeah, I would say that I won't call this a bluff, but I'm not I'm suspect about how long they last for, at least to this degree. I also would say this is the general audience here, we're talking macroeconomics, that tariffs and taxes, I don't care. Immigration is what rubber meets the road. You know, we get rid of 75,000, illegal immigrants who got parking tickets or whatever else they got arrested for. Big deal. You go and deport 1 million people, now we're talking real money. And so I would keep my eye on immigration more than tariffs and taxes.
Not only are you talking real money, you're talking real emotional distress that in turn will affect how everybody behaves.
Yeah.
So
GDP is people times hours times productivity. Productivity ain't changing that much. Hours ain't gonna move that much. You go and deport 1 million people out of the 8 million that are here. That's lights out, man.
totally
Not the location for this conversation, but third generation Irish Catholic. If we don't have an easy path to immigration, I mean, it's what the country is built on. So maybe we have an adult conversation at some point about how to make the process more simple to allow the right people into the country and be civil and welcoming about it. I mean, I realize that's an unpopular discussion these days, a toxic one even, but I mean, I think that's one of our larger problems also.
Yeah, and I would emphasize also, I completely agree with both of you that part of the challenge here is the uncertainty. Are these tariffs going to be withdrawn? Is the firing of NSA personnel the start of the Trump administration, inevitable byproduct or inevitable juggling of appointees, et cetera? They were remarkably disciplined and fast in getting stuff through in cabinet level appointments in the first cycle. I've emphasized this repeatedly. They took a blitzkrieg status. The thing that kills a blitzkrieg is that you get bogged down and your opponent is able to organize. And now suddenly you've got extended supply lines and everybody starts to look like an idiot. Don't know if that's going to happen, but it does feel like the probability of that is increasing. We are starting to get the proverbial Milton Berle sheep hook here from the team. So I do want to round it out. John, just one last quick question for you. If
Please.
you were a betting man, which I know as a trader you are, credit spreads from here, right? We got a nice pop. We're sitting in the 400 range in the high yield space for the first time. Is this where it stops? Does it turn around, or do you think we push higher?
I think on the upper end of credit, you're okay. I'm thinking of consumers again. I'm thinking housing and mortgage, you're probably all right. If you're on the lower end of credit, you're in trouble. I'd stay away from subprime. I'd stay to super prime, depending upon where you want to push into what individual asset.
And let me ask one more question here then. If the GSEs were privatized such that you didn't totally rip away the guarantee, but you kind of made it kind of suspect.
You can, right.
How much wider do mortgages go?
100 basis points easy.
Yeah.
So right now,
in a blink.
So it can't happen.
So tens are right now are 405. Your Fannie 5.5.
6.5 is today. Yeah, 6.5 coupon is a par kind of level-ish on a mortgage today. So you're talking about overnight a 7.5% mortgage.
And where do whole loans trade versus prime mortgages or Fannie?
So if you think of it just kind of quickly and easy, if you look at the bond yield, we're going to be about 100 basis points in yield through where you would deliver to the mortgage-backed security, because one, it's less liquid, and two, it's that manual underwrite of credit.
Good.
There's no full faith in credit behind me. And look, bad things can happen to good people. A loan can go bad, and you got to deal with it.
I'll tell you that 3 years ago, you had JP Morgan making loans through the Fannie Freddie rate. So
no, they were JP Mac. I mean, Jamie Dimon made the statement he wanted to be the single lender for banks. He wanted to be JP Mac. That's what he wanted. He took over the jumbo market. He was really ahead of even First Republic. He wanted to own the borrower and the wealth management and the commercial loan and the credit card and the HELOC and the private wealth management, all that goes along. He wanted that in to the borrower through the jumbo mortgage. And he did it.
It worked.
He did it pretty damn well too.
Yeah.
I will tell you one quick funny story, which was my son years back had a Model UN simulation in which they were reliving the global financial crisis, and he happened by the luck of the draw to draw his character was Jamie Dimon, And as we talked about it, I'm like, you just won this game. You don't even know it yet. Let's talk through how
You
you're
got so much to talk about. Yeah.
and nobody else will, right? It was an astonishing running of the table for him. He was like, wow, that was a really nice, lucky place I got into getting that position. All right. So with that said, John, this was absolutely fantastic. I want to remind people that next time on Keeping It Simple, we're going to get John Comiskey. John has been one of the leaders in terms of using quantitative techniques to break down the actual RMBS market, the opposite of what John is focused on. He is one of the people who has been leading the charge in exposing the shenanigans at the FHA. Should be a really fruitful conversation in which Harley has his hair blown off by the reality of all that is going on. So with that, I'll hand it over to Brian. Thank you again for joining us. John, is always such a pleasure. Even if you're Irish Catholic, we are thrilled to have you here. Thank you very much. Take care, Brian.
Really
All right,
enjoyed it.
gentlemen,
Thanks, guys.
thank you, everyone. John, thanks for joining us. Mike, you took the meat off the bone with the next guest, so we'll see you next time. Same bat channel, same bat time. Have a great evening.